How can you compare ETFs to mutual funds? Can you find a fee-only investment advisor for less than 1% a year? And can an investment advisor manage your 401k? We'll answer these questions and more on this, the 78th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody, this podcast is sponsored by Betterment, the most preferred automated investing service. Betterment has cutting-edge technology to optimize returns, minimize taxes, and save you time and money. Join over 34,000 customers who have already streamlined their portfolio management at betterment.com/roller. That's betterment.com/ROLLER. So today on the show, I've got Mitch Tuchman. He is the founder of Rebalance IRA. And so he and I have been chatting back and forth and decided to have him on the show to tell you a little bit about Rebalance IRA, which is a way for those that do want to hire an investment advisor that they can do so, and as you'll hear, pay quite a bit less than sort of the standard 1% a year. I had a lot of fun in this interview. I think you'll enjoy it. Mitch and I kind of talk about really a whole host of things as it relates to investing, and so I hope you'll enjoy it. Before we get to it, though, I want to respond to a question I received from a reader named Dana. I think it's a great question, very practical kind of question, and I thought you might benefit from it as well. And so here was Dana's question. She had met with an investment advisor who had recommended a series of ETFs, 6 of them in total. And she had listened to my podcast on ETFs and mutual funds. And she was starting to think maybe she should invest in mutual funds as opposed to ETFs. Now, I'm not going to, of course, go back through my views on mutual funds versus ETFs. You can check that out in podcast 39 if you'd like, doughroller.net/podcast39. I think the long and short of it is, for most investors, most of the time, particularly if you're comparing an ETF with an index fund, an index mutual fund, there's not going to be a huge difference between an ETF and a mutual fund. Sometimes the expense ratios on ETFs can be less, although not always. There can be some tax advantages to ETFs generally, although with well-managed index funds, they're usually pretty tax efficient. And that's where things get a little hairy when you're reading things online where they'll say, ETFs are just cheaper and they're much more tax efficient. That is absolutely true when you are comparing an ETF with an actively managed mutual fund. When you're comparing it, though, to, say, a Vanguard index fund or a low-cost Fidelity index fund, those advantages kind of disappear because you're dealing with mutual funds that are very, very inexpensive. Usually, 5 to 10, maybe 15 basis points. And for Admiral shares with Vanguard, for example, your expense ratio on the mutual fund side is the same as it is on the ETF side. And they're very tax efficient. So, again, you've got to it's not enough to just generalize, I guess is my point. You've got to look at the specific investments that you're interested in and what you're trying to achieve. And sometimes in the ETF might be either a very good option or even a better option. But not always. You've got to get very, very specific. Another issue is oftentimes with brokerage fees. We have to pay brokerage fees when you buy an ETF. Well, that's generally true, but not always true. And I can buy at my Vanguard account a Vanguard ETF and there are no brokerage fees. And they automatically reinvest my dividends. So, there are generalizations, but you got to get very specific when you're ready to make an investing decision. So that's just a little bit of background. Dana's question was, how do I take an ETF and find a comparable mutual fund? If I want to get the mutual fund version of an ETF, how can I do that? Now, I had talked at one point in a previous podcast about a tool on Morningstar called Fund Compare. It's a way you can compare mutual funds. It unfortunately doesn't work with ETFs, But just as a sort of a refresher, if you go to Morningstar, click on their Tools tab, you'll see there's something called a research tool called Similar Funds. Now, this is a premium tool, which means you have to have a paid membership at Morningstar to use it. But it is a very good tool if you're trying to compare mutual funds, particularly if you're trying to compare actively managed mutual funds. It's easy to find if you're looking at one S&P 500 index fund and you want to find others. That's usually pretty easy to do and easy to compare. Things get trickier when you're trying to compare actively managed funds. And this Similar Fund tool can be of help to you. So I mention it, but that doesn't help Dana's question. So how would you do that? For example, one of the funds that she mentions is is got a ticker SPY. And if you just dropped that into the Morningstar, not their fund compare tool, but just their quote box at the top, you'll see that it's the Spider S&P 500 index ETF. And so in that case, how would you find a comparable mutual fund? Well, that's fairly easy because once we know what it is and we see, it's an S&P 500 ETF, then we can just search for an S&P 500 index fund. And there are of course many of them. I invest in the Vanguard version of the fund of an S&P 500 index fund. I also have money in the Fidelity version. Things can get a little trickier though. For example, another fund that she mentions is IEFA. And so if we plug that into the quotes, and you'll see that it's an iShare Core MSCI foreign fund. It invests in foreign stocks, and that might get a little trickier. So how would you go about finding that? Now you could trace the index because this ETF, of course, follows an index, and so you could just find another fund that follows that same index, and you could do that a couple of ways. You could do a Google search. Morningstar has tools to find it. But one of the things I suggested to Dana, and I think maybe the easiest way, is to call up the mutual fund company you're going to use, whether it's Vanguard, Fidelity, Schwab, whomever, and just ask them. You could even give them the list of the ETFs, and they would be able to tell you, well, here's what we offer that's comparable, and here are the differences. In the case of Vanguard, what you'll find is they offer ETF and mutual fund versions of virtually the same kind of investment vehicle that tracks the same index. Depending on the class of share, it's going to have the same expense ratio, and they offer those in both ETFs and mutual funds. And you'll find that other mutual fund companies do the same thing. So that might be the easiest way. But again, if you wanted to do it yourself, just look it up on Morningstar, see what index the ETF follows, and then find mutual funds that follow the same index. And again, there are small cap indexes. Of course, there's the S&P 500. There's an emerging markets index. Foreign developed country indexes. There's indexes that follow the bond market, and so you'll find probably when you dig into this far more information than you need. But with these tools, with Morningstar, and then just picking up the phone and talking to someone at Vanguard or Fidelity or Schwab or wherever, you should be able to construct a portfolio that mirrors, in this case, ETFs, but within mutual funds. Now, one of the things that I plan to do, I've got it on my to-do list, is to put together a podcast and a blog post that gives sort of what I think to be a core portfolio of probably 3 to 5 mutual funds that at least I think makes up a good, solid core investment portfolio, and then show you the mutual funds that you could use to execute that asset allocation from several of the major mutual fund companies, not just Vanguard, but throw in Fidelity and Schwab and others. One of the things I remember when I was first starting to invest is I'd read a book, and they would give very specific mutual fund suggestions to execute an asset allocation, but I didn't have access to those, either because I was trying to invest in my 401k and they just weren't options, or in some cases, the funds weren't available to me because they required an investment advisor to get access to them, or high fees, and I just wasn't willing to pay them. And so I had a hard time figuring out how to translate their suggestions, which I liked from an asset allocation perspective, how to translate those into either the funds that were available to me or the funds that I was willing to buy. And that's kind of Dana's dilemma. I think in her case, though, since these are ETFs, they track various indexes, she should be able to find comparable mutual funds very easily. So Dana, I emailed Dana separately. Hopefully that answers her question. And if you've encountered that, hopefully that'll give you some help as well. And like I said, I do have on my to-do list to put together a blog post and podcast that covers that in a little more detail. Okay, with that, I want to get right to the interview with Mitch. Mitch, welcome to the show.
Thanks, Rob. Thanks for having me.
Well, I appreciate your time today. And let's just dive right into it. Folks already know that you're with Rebalance IRA, and we're gonna obviously talk a lot about that company and what you all offer. But let's kind of go back to the beginning and just give everyone a little bit background on you and how you got into this business.
Great. Well, it all goes back to probably the late 90s. I was a Silicon Valley software entrepreneur for many years. Sold a company to a company called Inc2Me, and for the first time, I had achieved my own financial freedom. I was financially independent. But the other part of that was my wife and I had just had a baby a year earlier, and he turned out he is and was disabled, and we were dealt that card and didn't really know how to handle it, but knew that it would be a huge financial burden for us, as well as 50 years after we had passed away. How do we take care of this child well after we're gone? And so, one hand, financial independence; other hand, financial burden way after my retirement and death. So I faced a situation was, what's the best thing to do? How do I best handle this? How do I invest my money? What's the proper way to do this? And who does it best? Who does this the way it should be done? And in my journey and seeking and questioning, I ran across a lot of answers that I didn't find satisfying, like Goldman Sachs and Smith Barney and Morgan Stanley and all the usual suspects. So a friend of mine who ran a hedge fund said to me, well, hey, you can find the answer by talking to my limiteds who really understand this, but why don't you come work for me? I need a guy who knows technology, and you can have access to them, and I could definitely use some help with what you know in terms of helping me analyze technology stocks. So a one-day-a-week consulting gig turned into a 7-year career in the hedge fund industry, and I was able to have access to the best and brightest people who manage money for institutions that are required to do things like pay retirees money every month or cover the operating expenses of an institution. And so in talking to these people and learning their methods, I learned that the way they think about money management and the way they think about handling large amounts of money was 180 degrees different than the conversations that I was hearing on CNBC or from all the financial services institutions that wanted to take care of my money. It was literally diametrically opposed. They didn't speak about which stocks they were picking and their view of which way the markets were going. They spoke about asset allocation and how their needs would be best met by putting money in different buckets. And the distinction was so stark that I began to learn more and more, and I began to take their methods and apply it to my own money management. And as I got more and more into that, I realized, wow, this is something everybody should be doing and could be doing because two things had happened in the world. One was online brokerages were bringing the fees down below $10 to trade. And second, these new funds called ETFs were becoming available, which offered a variety of flavors of investing that would allow you to put together the right mix of investments to have what's truly a diversified portfolio. So the first thing I did was I started a software service, which is still alive and well and growing today, but it's for do-it-yourselfers. It's like TurboTax, but for investing. It's called Market Riders, and Market Riders does not do the investing for you, but it rather tells you exactly what to do to use this methodology. And then over time, many people wanted us to take over their accounts and manage it using the same process. So we began Rebalance IRA and launched that.
Okay. So Market Riders, that's at marketriders.com?
Correct.
And explain to folks what that does. It's a tool that helps you figure out what asset allocation is best for you?
It's like a financial advisor online. So if you sit down in a fancy office with a well-bred, educated person who's about to siphon off a lot of money in your account, that person's going to ask you a variety of questions. He's going to put it into some software, and he's going to come up with an investment mix for you. Market Riders simply allows you to use that software in a very easy-to-use user interface. So you tell the software how old you are, when you may want to retire, some questions about how much risk you can handle, how much investment experience you have, what your goals are, and it will suggest a mix of investments for you. Then you tell it how much money you have to invest, and it'll tell you exactly which trades to make at your own online broker. So whether you use ShareBuilder, Schwab, Fidelity, E-Trade, no matter where, you go take that recommendation, execute it, then Market Riders will tell you when you need to make some changes. We call that rebalancing. But you do everything, and that's a $150 a year service. And so there are many people subscribing to that and enjoy the fact that they have complete control of their accounts, but they have to do it all themselves.
Okay, so Market Riders is for do-it-yourself investors. And does it actually recommend specific investments, specific ETFs or mutual funds?
Yes, specific ETFs. So a typical Market Riders portfolio will be 12 ETFs, and it will say buy 23 shares of BND, buy 18 shares of ETI, 7 shares of IJR. It'll give you the exact numbers of shares of each ETF based on current prices of those ETFs. But the most important thing is it says, okay, Rob, you're a guy, you're 45 years old, you have these parameters, you should have 80% of your money in stocks, 20% in bonds. And within stocks, you should have U.S., foreign, emerging markets, small cap, real estate. And it literally gives you a great mix and then the specific numbers of shares of each fund to buy.
Mitch, the best part of that, you had me when you said I was only 45. I really appreciate that.
You know, Dave, at 35, I was hoping that I would be insulted.
For those listening, Mitch and I are actually on a video call, so he can see me, and he knows full well that I don't look 35.
Well, we both have gray hair.
Yeah, we do.
Both very distinguished,
yeah.
I may say so myself.
So before we get to Rebalance IRA, which I know we're going to spend most of our time there, so for Market Riders, and this may apply for Rebalance IRA as well, why ETFs as opposed to mutual funds?
Because with Market Riders, well, there's a few reasons. First of all, we love the ETF structure from a tax standpoint. Without going into great detail, you can buy, hold, and rebalance an ETF, and for decades accumulate unrealized gains and not be subject to the other actions of other fund holders. So mutual funds, people can get caught by getting taxable income because other people in the fund did certain things. Number two, mutual funds are only available in the places in which they're distributed. So if I run a mutual fund, I have to make deals with certain brokers so that they'll show you my mutual fund. And that's where a lot of these back-ended fees come in, and it's where the whole, quote, distribution model of financial services starts to create a bunch of just bad business practices in our mind. So we love ETFs because you can buy them anywhere. Think of an ETF, you can buy them. If you can buy IBM or Google stock or Apple stock, you can buy any ETF available at that broker. And then third, and as important, one of the really important things in managing a portfolio with this methodology is that it is periodically rebalanced or tuned. And the simplest way to describe that is that if I have a stock portfolio that's half stocks and half bonds, over time, if the stock market's doing really well like it did last year, and the bond market's doing really poorly, that portfolio could be 55-45. And so you want to take 5% off of the stocks and add it to bonds. Those trading costs can add up, particularly with mutual funds. And the beauty of ETFs is that the cost of rebalancing, which should be done once or twice a year, is very inexpensive because of the brokers who are now competing and driving these trading costs down. So for all these reasons, we love ETFs, and they're really become bastardized. There's 1,400 of them now. Frankly, anybody who needs, there's 10 or 20 that are appropriate and needed. The rest of them are not that important in our world. So.
Okay. All right. So you started Market Riders for do-it-yourself investors, and you said some of the folks there said, "Hey, Mitch, we'd really like a little more help. We'd like someone to help us manage our money," and that led you to Rebalance IRA.
Yes, we're all emotional people, and when we've worked hard to put money in an account, and we look at that account as the way we're going to have financial freedom one day. It's very difficult for people to have the capacity, even if they understand the method of investing that I'm describing, to execute that method of investing. So what they really wanted was a trusted third party to execute this method, which means that when the markets are going down, to talk them off the ledge and not go to cash, or basically do all the things that we as humans are wired to do that are exactly the wrong things to do at the wrong time from an investment standpoint. And a lot of people are busy, and they're lawyers or doctors, and they just don't have the time. They don't want to be bothered. So the question was, would you just execute this strategy for me? And then my answer was always no, because the business I would have to have created would have been too costly, and the fee would have been too high, where I would not be adding value to my clients. Rather, I'd be taking value away. Because fees, as you know from your whole mandate at your site, are the enemy of everything we're all trying to do. So it was only until we were able to figure out a very interesting model for delivering this low-cost advice to the people who needed it the most, which are people who have, in our target market, 100,000 to maybe up to 1 million. How do we solve for having a relationship, bringing advice to clients like this that are in that world, in that area, for something like 0.5%, not 1.5%. And once we figured that out, we were able to launch Rebalance IRA.
And how did you figure that out? What had to change, or what did you do?
So there were a few key variables to it. One was we needed an amazing amount of credibility to cut through the noise, so that when we launched this service, people would pay attention and say, wow, this is serious. This is not just some other service. So number one, we were able to recruit the most important luminaries in the investment business from our standpoint. So Charlie Ellis, who is at Yale, and Charlie oversaw the Yale Endowment on their investment committee. David Swenson, who's the Warren Buffett of the world of endowment and pension investing, reported to Charlie. Charlie saw us as a vehicle to bring all of these methodologies to everyday investors, and he signed on as a first member of our investment committee. With Charlie, we were able to recruit Burt Malkiel, who's one of the founding board members at Vanguard. Burt wrote the seminal work that was expressed in a book called A Random Walk Down Wall Street, which is now, I think, in its 11th edition. Anyone who took a finance course in the 70s till today still reads that book.
Great book.
It's a great book. Burt joined our investment committee. And then Jay Vivian, who took all of the work of Burt and Bogle and all of the index investing luminaries to heart while he was running the largest pension in America, IBM. Jay took a $100+ billion pension at IBM and converted it to this method of investing. So those three guys sit on our investment committee and have created and actively review and modify our model portfolios. So we figured with that kind of credibility, our marketing costs would go way down. Second, we were able to use a lot of what the media now calls cloud-based technologies to run our office in a super efficient way. So we look at 100 little decisions on running our business and have used technology which I won't go into, but we run a super efficient operation, so we can pass all that to our clients. And third, we found a phenomenal group of people that we've been able to access who are well-trained, generally MBAs with financial backgrounds, who want more of a flexible work style. And we have a way of working with a set of advisors who can bring true expertise to individuals. So with those things, and in addition, when you manage money the way we do it, your operational costs are way lower because we're not actively trading, we're not forecasting the future. 100 things. We work with Schwab and Fidelity. There's a lot of tools and technology we're able to leverage from those firms. Net, we can have a profitable business managing a person's $100,000 for 0.5%, $500 fee, and the typical wealth manager today needs 10 times that amount. If you look at the wealth management industry, to provide this kind of expertise and service and advice that's personalized to a person, the model today with offices and highly priced full-time people, trading operations, et cetera, requires 1% and a minimum of $500,000, but generally up to $1 million. So that relationship requires a $10,000 a year client, and we can do this with a $500 a year client. So we do go very deep, though. We don't do a lot of things that wealth managers do. We focus on retirement, financial independence. Our clients are people who've worked hard, are working hard, and what they want and what we want for them is to have financial freedom. And either they're on the path to financial freedom or they've already attained it and want to maintain that. And our view is if we can help people get there or stay there, those people have less stress in their lives. They're more able to focus on the things that are important to them instead of the stress and struggle when you are in a survival mode in your life. And they help make their worlds a better place, and we enjoy helping them do that. So that's why we do what we do. Okay.
Well, so how does Rebalance IRA work for someone that is looking for an advisor and considering Rebalance IRA? How do they get started, and what exactly is it that you all do for folks?
So it's a very simple process. You go on our site, rebalance-ira.com. You click a very easy-to-find button to schedule a consultation with an advisor. You enter your information. You'll instantly receive an email where you can click a couple of buttons and schedule yourself on the schedule of a highly trained advisor. You'll have a 1 hour or so conversation, half hour to an hour conversation with this individual that's highly trained. We do very much like a doctor would do. It's kind of a financial workup. We take down a lot of information about you, and we learn a lot about you. Then we set up a follow-up call. For that call, we then present a plan. And this is all at no charge. And we talk to you about how we think you should reconfigure, reevaluate, change, make some things so that you can achieve financial independence, or if you're already there, make sure you stay there. If you like what we have to say, we do business. If you don't, we don't do business. We hope we created some value for you, and that's how we do our process. If you say you want to do business, we then if your accounts are at either Schwab or Fidelity, we put ourselves on those accounts and are able to manage them at Schwab or Fidelity. If they're not, we move them either to Schwab or Fidelity, and then we have a lot of periodic check-in calls the first year and a yearly call. And our clients are free to call us anytime they want. They have a team. They have an advisor and a support person on their team, and we hear from our clients sometimes once a year when we do a yearly review where we look at all the assumptions we made going into our advice. Want to make sure our advice is still relevant and current. And our clients will call us if things change. They're changing jobs. They're, any kind of different circumstance. We're there to advocate and be their advisor along this path.
Mm-hmm. Now, notwithstanding the name, Rebalance IRA, do you also manage taxable accounts?
We do, but with a big caveat. And again, our model is not to deal with accounts that have lots of activity, because that's expensive and we can't do that at 0.5%. So as long as the client has a taxable account that is a retirement account deemed for retirement, we manage that just like we do their IRA.
And when you manage a client like that, do you take into account asset location in terms of what types of assets to hold in a taxable account versus a tax deferred or Roth account?
Sometimes we do, but we don't do it in the way you might be suggesting, where we might put all the bonds in one account and all the stocks in another. And generally, we find that's not necessary, but we may do different allocations in various accounts depending upon the purpose. But it's all very individualized. We have clients in their 80s with Roth IRAs that we've heavily invested in stocks because they're planning to give it away to grandchildren. Everybody's different, and there's a lot of nuances. And that's why a lot of our clients tend to be baby boomers, because when you're 45-ish up to 65-ish, life gets pretty complicated. When you're younger, maybe you're paying off college loans, you're buying your first house, getting kids, getting a family going. As you get older, maybe you're married, your wife, husband has a couple accounts here and there. Things start to look like a yard sale, a 401k of an old employer. And that's where we come in. When it starts getting a little complicated, and when the light bulb goes off that says, hey, man, I just look back 20 years and I was getting out of college, and now I look forward 20 years and I'm thinking that I'm in my 60s. Light bulb goes off. This becomes much more important and much more complicated. I need some help.
Okay. And for online access to the accounts, do your clients simply just log into Fidelity or Schwab?
Yes.
Okay. And why? I'm curious, why Fidelity and Schwab as opposed to, other options?
Because first of all, they have enormous credibility with general clients. We're all worried about Madoff and things like that happening to us. And so we wanted to partner with firms where we could say to the client, look, we're going to open up your account with your name on it at a financial institution that's rock solid, Schwab or Fidelity. We'll add ourselves to that account with very, very limited authority to manage your money. And so we wanted to take the whole concern off the table of a no-name firm. And then it turns out that many, many, many people have accounts at Fidelity. Fidelity actually has, I think, 25% of all the 401k accounts in America on their platform. And we're focused heavily on this part of the investment industry. So they were great partners, and we now manage a lot of money on both.
So you can manage someone's 401k at Fidelity or Schwab as well?
Certain companies, yes.
Oh, now why is that? Why only certain companies?
Well, there's a very interesting thing that people don't know much about, but is a feature on many 401k plans. For example, if you work at AT&T, if you work at Kaiser Permanente, many of the tech companies that have a Fidelity 401k called Net Benefits, there's something that everyone should look at called brokerage link. And brokerage link is kind of a way where you can avoid all of the perhaps bad options that your company has provided for you in your 401k. And a brokerage link account at Fidelity, and it's called something else at Schwab, allow you to get all your money into this self-directed account. And in that self-directed account, you can do whatever you want. We can manage those self-directed accounts at Schwab or Fidelity.
So if you have a 401k and you have this self-directed option, it's called brokerage link at Fidelity, which I think I have, you would be able to manage that individual's 401k.
We do, yes.
Okay. And
and by the way, we call our company Rebalance IRA. We believe in balance. We think a lot of this relates to the holistic approach. So many of our clients, we look at their 401k options, whether we can manage it or not. We give them very specific advice on which funds to choose so that everything they're doing in their 401k plan is holistically tuned to what we would be doing in their IRAs.
Okay. Pardon me, I've been fighting a cold, so I keep trying to avoid this coughing. So you could help folks even with their 401k, even if they don't have the brokerage link option. It's just that they would have to go in and make the changes themselves for that type of account.
We actually we don't insist on it, but we'd prefer to do that. Again, we want people to become financially independent, have that freedom. And if they're doing something really dumb on their 401k side, and we're doing something really smart for them on their IRA side, that's not going to work.
Right,
so we really like to have the whole picture.
Okay. And now, in terms of the advisors that get assigned to a new client, are these registered investment advisors, or what are the qualifications of the individuals that folks would be talking to if they schedule a consultation with Rebalance IRA?
Well, we heavily vet the people that are advising clients. We have people who are very skilled at doing the intake diagnostic. But the most important role comes after that, where that information is translated into a plan of action. Those advisors all have a Series 65, so they have a certification, or that's a legal requirement by the SEC. But more important, they're all MBAs. They all have financial backgrounds, and they've all been trained by our company with our methodologies to give the advice that holistically would be the way to get people on the path our mission is to get them on.
Okay. Yeah, I was reading on your website. You mentioned on the website that you use advanced software developed in-house, and that I guess through this consultation process you develop what's a specific score.
Yes.
What can you tell us about that score and how that works?
So we want to know, there's a couple things that are really important and a couple things that are kind of important. One is, how old are you and when are you going to need this money? If you have a 5 or 10 year time horizon, that's one very important part of the scoring, because it means we want to try to get you into more of an equity type of portfolio. So it's time horizon, and when you need the money, and then how much of the money you're going to need. So if you're going to retire in 3 years, but you're only going to need 1 or 2 or 3% of the money, that's important. And then you have to balance that by a bunch of questions we ask related to what we in the business call risk tolerance. But it's really, really hard to get at that. It's how strong is your stomach when you're looking at your account in your market, your account's down 20%. So we try to get at that by knowing what kind of experience you have as an investor. People who've tended to do a lot of investing tend to have a lot of experience watching their account and dealing with ups and downs. And we try to get our hands around, have you had a lot of experience? What have you done in 08, for example? What is we call a risk tolerance? But we ask a bunch of questions, and we get a score for the client. That's kind of the quantitative part of our diagnostic. Then there's the subjective part. Well, tell us about what you're doing, your job, your family, spouse, kids. Do you have parents to support? Do you have kids going through college? We try to understand the holistic picture, and when we combine that whole picture together, we try to figure out how that person can get to a point where one day they can basically sit on their couch all day if they want, and money's coming in and it's at least a little bit more than what's going out, and that's going to stay that way till they're 6 feet under. And if we can figure that plan out, then we can help that person and get them where they want to go.
Right. One question I get a lot, because you mentioned time horizon, obviously very important. One question that I get a lot is folks that are retiring now or soon, and they want to know how much should go in equities and how much should go in bonds at that stage in life. Mm-hmm. And I know there's not one answer to that question. As you've mentioned, different folks have different risk tolerances. So some folks may want to keep a lot of their money and hope to one day pass it on to their children or grandchildren. So there's a lot of different variables. But can you just kind of give us, in broad strokes, your view on sort of the equity versus income or bond allocation during retirement? And by the way, I know I didn't prep you for this question, so this is consider this as like a pop quiz.
No, this is a great question. And the reason it's a great question is because the conventional wisdom of the way that would normally be answered is not relevant right now, because we are in a very tough spot in our economic history, as we all know, where our government is artificially manipulating interest rates because the government has deficits that will only get larger if interest rates were at a quote market rate. So bonds, which have traditionally, you open up any finance book written probably up to 2 years ago, bonds are the safe place to put your money, right? So the traditional trade-off is, okay, we have two choices. We can put you in all bonds on one extreme, which is give you a 5% return, or we can put you in all stocks, which will give you a 9 or 10% return on historic averages. The good news is if you have enough money and 5 is okay, you'll sleep at night. You won't see much volatility in your portfolio. It'll stay the same number, and you'll check your coupons. And if 5% will cover you with inflation over your lifetime, you're good to go. Let's do that. If you take the stock route, you get 10%. Your money, can double every 7 years. With the bond route, your money's going to double every 12 or 15 years. So pick your poison, or somewhere in the middle, and let's do that. You can't do that though today because bonds are not yielding 5%. 10-year treasuries are yielding 2.5 to 2.75%. And when interest rates go up, the bonds themselves are going to depreciate in value, so you're going to perhaps lose money owning bonds. In fact, last year was the first year in 15 years bondholders lost money. So the answer to that question, there's no more rules of thumb that work. The old, take your age, subtract 100, and that's that. It doesn't work. It's a difficult question. So the way we help people answer that is, first of all, do you have more than enough to cover your living expenses if you were to get a 3 or 4% return on bonds? If so, do you care about volatility? And so I guess the answer is it's more complicated.
Okay.
I wish I could answer it. I'll tell you though I'll give you a couple scenarios.
All right.
So one couple we just spoke with, she's 58, he's 65. They need $120,000 a year to live on. They have $1 million saved up. They hate volatility. They have no other source of income. And they're in trouble because $1 million, you cannot withdraw 120 grand. Even if you would take out his Social Security and eventually hers, that $1 million is not going to last. So it has to be more aggressively invested, and they hate volatility.
Yeah, that's between a rock and a hard place there.
It's a rock and a hard place. So that couple, we have to coach them on getting more aggressive and showing them that a globally diversified portfolio, like the types that we construct, have always recovered. So even though you're going to lose perhaps one day in a correction 20% or feel like you've lost it, if you just stick with it, that's the right way to go. That's a tough one. That's where an advisor adds a lot of value.
Yeah.
Another couple, talked to a couple $1 million, a pension from a retired cop of a lot of money, and really no need to take any handle any volatility, and don't like it. So, ironically, that kind of person can be more aggressively invested because they got a pension coming in. We try to show people that pension and Social Security payments, if you equate that to a 3% return, can oftentimes look like a multi-million-dollar bond portfolio. And we try to equate that to a multi-million-dollar bond portfolio and put the other savings in that perspective with their allocation decision. So a lot of what we do is educate. And
right.
And it's really difficult today because we haven't had a real correction in about 2.5 years.
Yeah,
So,
it is difficult, and this is just my own view. I don't for a minute, and folks that have listened to this podcast, know that I don't try to predict the market. I was convinced interest rates would have gone back up 4 years ago. That's how good I am at predicting anything. But they will go up someday, and as you've pointed out, when they do, the value of bonds will go down. And equities will have pressure as interest rates go up as well.
mm-hmm.
And so it'll be an interesting time for folks. And I guess we'll wait and see. But I guess the long and short of it from your perspective for folks in retirement is there's just really no rules of thumb. It's very specific to the individual circumstances.
Yeah, so it is, but here's a couple rules of thumb. If you have $1 million put away in an IRA or SEP IRAs or whatever, if you pull 3 or 4% out a year and you can invest it in a portfolio that's 60%, 70% equities and handle volatility, then the portfolio should be able to allow you to pull your 3 or 4% a year out and protect yourself from inflation.
Yeah.
Okay. And if you need to pull out more, then you better get more aggressive in equities. And because you can't pull out what the portfolio earns, because you'll find yourself in 15, 20 years feeling very, very poor.
Because of inflation.
You'll find that the $60 steak dinner is like, you can't afford that anymore. So, 3-4% on a pretty aggressive portfolio is a great mix for now. And we like to show investors how to get used to volatility, but have a very well-diversified portfolio that will withstand it. Look, dividends today are paying more than bonds right now.
I know. Yeah. Yep. That's been a focus of my own investing. They've definitely returned better than the bonds. The good news about it, raising interest rates, though, yeah, your current bond portfolio will take a hit, but as particularly on, if you have an intermediate term bond fund that's going to buy and sell to reset its duration, yes, it's going to be investing in higher rate bonds, so you'll eventually do okay. It'll just be a hit to begin with, but.
Well, that's exactly why in our income portfolio, the bond portions of our portfolios, they include two things to that point. One is we do use high yield bonds, a high yield bond fund, and that's because those issuers, while they might have a little more credit risk to them, they're not allowed as a result of that they're not given the opportunity to issue long-term bonds. So the durations the maturities are averaging 4 or 5 years. And the other fund that we use, which to your point is very helpful, is on high-grade corporates. We use a 5 to 10-year bond fund because the 10-year bonds in that fund become 9, 7, and 4, 5-year bonds. And as they come in, as their maturities come in, they appreciate in value given where the yield curve is. Mm-hmm. Because between 5 and 10-year maturities are about 1.75 to 2.5. So that, as you know, gives you kind of a built-in hedge. So right now, our reaction to this market is that a 5 to 10-year VCIT, the Vanguard fund, is a really great place to put some money.
Okay, good. Well, I appreciate that. Well, anything I've not asked you that I should have, or anything else you'd like folks to know about what you guys are doing at Rebalance IRA?
Boy, I was in react mode here to your questions. No, I think that pretty much covers what we do. I think the main thing we try to talk to clients about is that even if you are the type of person where your emotional makeup is that you really want to delegate investing to somebody else to handle this, which is our client at Rebalance IRA. We call them delegators in the industry. They're a person who is busy, they're just not interested in investing. They might not even be listening to this podcast because they'd rather be listening to a travel podcast. But those kind of people, I guess the best advice is, because they need to trust somebody, because they want to delegate the management of their money, that they seek to trust not a person, not the person they play golf with because they like them, but to trust an investment methodology that'll help them get there. And you can compare and contrast various investment methodologies. And I think the one you advocate and we do is, if you build a portfolio that's very low cost, using low cost index funds that has diversity, in other words, the portfolio owns through its funds 10,000 stocks and 3,000 bonds. If you own that kind of a portfolio, you're really, not only are you lowering your costs, but you're lowering your risk, because you're not making bets. You're not having someone else making bets with your money. The only bet you're making is that the global capitalistic system will not fall apart. And if you make that one bet and you keep your costs down and you use this process that anyone can read about, and you can trust a process. Find one you can trust, not a person, not even an institution, but a process.
All right, good. Well, one last question, Mitch, before I let you go. If you were going to recommend one book on investing for folks to read, what would your recommendation be?
Hands down, it would be The Elements of Investing, and it's written by two of our members of our investment committee, Bert Malkiel and Charlie Ellis. It's a simple book. I think it's about 100 pages. It's written for laymen, and it very, very succinctly describes our investment process and the one that they've been advocating and building upon for decades.
Okay. And I actually see it on your site,
Yep.
The Elements of Investing. Good. Well, I'll leave a link in the show notes for folks so they can check that out. Hey, Mitch, I really appreciate your time. Thanks so much for being on the show.
Thank you, Rob. Thanks for having me.
Well, I hope you enjoyed that interview. If you have any questions at all about Rebalance IRA or any of the other things that Mitch and I covered, don't hesitate to shoot me an email at dr@DoughRoller.net. As I've said many times, I read every email, and it's getting harder to do, so it may take me a day or two to get back to you, but I do read every email, and I respond to every email. Happy to hear from you. You can check out the show notes to this episode at DoughRoller.net/podcast78. You'll find there a transcript of the interview and links to the resources that we mentioned during this episode. Hey, until next time, remember, the best thing money can buy is financial freedom.